Successful stock and CFD traders know, and new stock and CFD traders eventually learn, that the most important aspect of trading is proper money management. If you don't manage your money correctly, you will most likely run out of money to trade. Most traders fail to practice good money management when they become too greedy. When traders become too greedy, they risk too much of their money on too few trades, and if those trades go against them, which seems to happen more often than not when you're being greedy, they lose everything they have. Look at it this way. Suppose you have $10,000 and you risk 50% of your money on one trade and you lose, bringing your account value down to $5,000. Now you have to make 100% on your remaining $5,000 just to get back to where you were to begin with. You must ensure that you can live to trade another day. Even if you only have a portion of your money left, make sure that you have at least something left to trade with. The best way to ensure you will live to trade another day, even if all of your current trades go against you, is to decide beforehand how much of your account you are willing to risk in any one trade. For example, you may decide you only want to risk 2% of your account in any one trade. That means if your trade goes against you, you will still have 98% of your account left to trade with and recover from your loss. Once you have decided how much of your account you are willing to risk in any one trade, you now have to determine how large your trade should be. You can use a simple formula to help you determine your trade size. First, you have to know how much of your account you are willing to risk in one trade. If you have a $10,000 account, for instance, and you only want to risk 2% of it, you can risk $200 in one trade. Second, you have to decide where you are going to set your stop loss once you enter the trade. Once you have determined where to place your stop loss, you have to figure out how much distance lies between the point where you are going to enter the trade and the point you have determined to use as your stop loss. Now all you have to do is plug these numbers into this formula. The amount at risk divided by the distance between the entry price and the stop loss price equals the size of your trade. If you plug the numbers we've been discussing into this formula, you will get something like this. $200, which is the maximum amount of your account you want to risk, divided by $5, let's say this is the distance between your entry price and your stop loss price, would give you 40 shares. This tells you that you should buy 40 shares or contracts when you enter the trade. Having this information will help you prevent risking too much in one trade. Lastly, let's talk about the tremendous tool that you can use to help ensure you don't lose more than you expect to on a trade, a stop loss order. A stop loss order is a trade order you will set with Saxo Bank that tells the trading system to automatically take you out of a trade if the stock or CFD rises or falls to the price that you have previously chosen. If you buy a stock or CFD, you will place a stop loss order somewhere below the current price. Setting your stop loss below your entry price will protect you in the event the stock or CFD turns around and starts moving lower. If you sell a stock or CFD, you will place a stop loss order somewhere above the current price. Setting your stop loss order above the entry price will protect you in the event the stock or CFD turns around and starts moving higher. Even if you can't be monitoring your trades 24 hours per day, your stop loss orders can be protecting you around the clock. Protecting your trading capital is your first responsibility as a stock or CFD trader. Know how much you are willing to risk. Use stop loss orders to protect yourself. Live to trade another day.